What's going on, everybody? It's Brian Trippe. Welcome to another episode of the Real Estate Investing Live podcast. I am in Birmingham, Alabama. I'm so glad you decided to join us today. We interview the very best real estate investors, entrepreneurs, and business leaders all throughout this great country. And today is no different. We've got a very special guest, Mr. Edwin Kelly. How's it going today, Edwin?
Brian, it's awesome, man. How are you doing?
Doing very good. I'm excited to dig into self-directed IRAs, health savings accounts, which we definitely have not talked about on this show yet. Maybe some Roth strategies that you just got done telling me offline that's just something that people just don't understand the power of and how we can actually implement those. So I'm very excited. Edwin is with Specialized Trust Company, CEO and founder. And so we're really going to dig into this subject. I'm very excited about this. Let's just start right there, Edwin. Tell us about the company. Tell us specifically what you do and how you got started doing that.
Yeah, so you know what? It's funny. I'll give you the Cliff Notes story, Brian. But my whole career actually started back in sixth grade, believe it or not. I was raised by a single mom who was a social worker. So if you know anything about social workers, they have big hearts and small pocketbooks. So we didn't have a lot of money growing up. So I started actually working when I was in sixth grade doing odd jobs. And I grew up in Ohio. So anybody listening, if you're in Ohio, you know the one great thing about Ohio is that there's lots of crappy weather. So there was leaves to rake, lawns to mow, snow to shovel. So I could get paid, doing whatever. And so I started doing that in sixth grade. By the time I got into middle school, I was saving my money. Don't ask me how I figured this out. I don't know. But I opened up an UGMA account, which is basically a brokerage account. And so I opened up this account, I put money in it, and made my very first investment. And the long and short, I won't get into the details on that, but the long and short of it is this. A year after making this investment, and truthfully at that stage of the game is pure luck. Like it was. I could probably call it intuition, but I'm not going to oversell it. So, but what happened was I made more money in 1 year investing than I did an entire year previously working those crappy jobs. And so what I realized was the money and the wealth is created through investing. And that's really what started me on this path. And that's where, along the way, I discovered self-directing and retirement accounts because they offer so many benefits and bringing all these things and connecting all the dots. And so, I started doing it myself, started helping other people with it, and found that there was a need in the self-directed retirement account industry for a provider that not just delivers the service and really good service at that, but also offers a lot of support to clients who are trying to figure out what this stuff is, how it works, how it ties into their plans. And so that's kind of the other side of the business. So that's the concept behind it. And so just to kind of real fast, we're Specialized is a self-directed IRA custodian and administrator. So that's the core service we provide, but we provide a lot of support around that service.
So this is a topic that's Edwin's going to put a lot of people to sleep. So help me right off the bat. You got to help me right off the bat. Like, give me some, like you mentioned one really exciting thing. I love this. You discovered at a very early age that the true money and wealth comes from investing, not necessarily working and earning, it sounds like. Give us some exciting nuggets, like some exciting teasers that we could talk about the rest of the show to really keep people's attention. Because this is going to put a lot of people to sleep.
Yeah, no, you know what? And that's the funny thing is that too many people think that self-directed retirement accounts is not sexy. It's very sexy.
All right, convince us.
So if you're listening, trust me, this is going to get really good. One of the number one things that I'll share, and there's always a few things that I always share, but as I think about it right now where I'm at and the clients that I work with and the people we're talking to, number one mistake I see everyone and anyone making is that they do not have a Roth strategy.
Okay, let's talk about that.
So this is key. So first of all, here's what a Roth is. A Roth is like a Roth IRA. A Roth account is one where you put money in today, right? So you make a contribution this year, as an example, and we don't take a tax deduction, but all the money in the account grows from investing, right? Tax protected. And then when we go to spend money in the future, it comes out and we don't pay any taxes on the distributions. So, right, no capital gains tax, no income tax, right, no tax. If we pull $10,000 out of a Roth next month, we get to spend all $10,000. So I'm just going to kind of assume that people have a basic understanding of a Roth. If not, be happy to answer more questions about that. But here's the power in that, because most people do not have a Roth. Okay. Now, why do not most people not have a Roth? And if they do, it's almost a side note, Brian. Like when we open up accounts for people will move over, say, $100,000 or $200,000 in a tax deferred or like a traditional account, and they might have $5,000 or $10,000 or maybe $20,000 in a Roth if they have one at all. Why is that? Well, what I believe is, in all the conversations the years I've been doing this, is due to two reasons. First reason is traditional and tax deferred accounts have been around a lot longer than tax-free accounts, right? So most people have their money in a tax deferred account. The second reason is that a lot of people, when they're going to their tax advisor or whatnot, they're saying, hey, look, don't do a Roth. You're in your peak earning years, or you're paying a lot more in income taxes this year. So you want to take the deduction right now, because you're going to be in a lower tax bracket in the future. So that's why people don't have a Roth strategy in my mind. Okay. So why is the Roth so important if you are committed to, and I'm just going to speak for people generally right now. If you are committed to rescuing your retirement, because most people don't have a retirement that's actually going to work for them. If you are committed to rewriting your family legacy or creating a family legacy in the first place, the best, easiest, most effective way to do that is with a Roth strategy. So I'm going to give you some quick numbers. Just jot these down, and this will paint the picture of why I talk about the Roth being so compelling. Okay, I'm going to give you an illustration. So assume that you take $5,000 a year. And actually, Brian, I'm going to back up. I'm going to give you the end result. I'm going to show someone, I'll show you right now how to make $100,000 a year in tax-free income and spend it over the rest of your life. Okay, I'll show you how simple this is. So this is the illustration. So the end result is we're going to get $100,000 a year in income in the future. End result. So here's the illustration. You take $5,000 a year and you contribute that to an account. Okay, if you're earning 10, and we're going to do that for 30 years. So $5,000 a year for 30 years. That's $150,000 in contributions. Let's assume we're making 10% on our money as we're going through time. What is our account value at the end of 30 years? Well, the answer is it's $991,000. Now, it's interesting because when I talk to folks, sometimes they'll say, well, I ask them about their goals, right? So one of the first things we got to get clear on is their goals. And so the goal you want to have is an income goal, right? Because that's what enables you to live your life. So if you have an account worth $991,000 a year, we can't spend that, right? That's our nest egg. But what can we spend? Yeah. We can spend the money we're making off it, right? The interest. So 10% on $991,000 is $99,000 a year. So now here's the question. If that's coming from a Roth, that $99,000 you get, you pay tax on, right? You get to spend that $99,000 a year. But most people aren't doing that.
Why?
Because they're sold on the idea that, well, I get this tax benefit today, right, by taking the deduction. Okay, so let's go. Let me break down the math for you. You made $150,000 in contributions. That means, right, you took a deduction on $150,000. Now your account has grown to $991,000. So traditional is tax deferred, meaning the government's going to recapture some of these taxes in the future, or it's tax free. They're never going to touch it. Well, so here's the deal. You booked over that period of time an $841,000 capital gain. Now you do that in a traditional, at some point you're going to get taxed on $841,000. Right. You do that in a Roth, you're never getting taxed.
Right.
But now think about when you start spending the money. Year one, you spend $99,000, right? No taxes from a Roth. Year two, you spend $99,000. You just came out ahead because the only thing about the deduct was $150,000. So this is the challenge that people have.
So Edwin, you're in the business, so I'm not in your business, obviously. But from what I hear from people is what you just said, I don't know of anyone that doesn't agree with what you just said. Like everybody's doing that I know of. Maybe everybody my age, I'm not sure. I don't see people opening up IRAs today that are not Roths. Most people are opening up Roths. So like, let's just, if you're not, I think that you've sold the people who weren't for sure. And if you're not, I think it's mostly agreeable. This is the question I have for you though. Let's apply this to real estate investors. How do we apply this specifically to real estate investors who are maybe making whatever? They're making a certain amount of money per year, but they're not getting any money taken out of an account or out of a paycheck, I mean. And they're having to go and now, contribute to something. Or maybe in certain circumstances, the rules. There's certain circumstances where if you make a certain amount of money, you can't contribute, or you can only contribute so much. What is it, $5,500 a year or whatever it is? Talk about specifically to real estate investors that are self-employed people.
Yeah, so the great thing about being self-employed or being a real estate investor is that you can go beyond, you just mentioned it, Brian, right? The IRA contribution limit, which changes from year to year, but those contribution limits are a little lower. The great thing about being a real estate investor or an entrepreneur, business owner, is that there's other plans that are available to you. Yep. So you can actually go well beyond the $5,500 contribution if you elect, right? In fact, that's one of the things I'll just mention real fast that we do. So when we bring on a new client, we create what's called a custom plan design. So accounts fall into three categories. You have your IRAs, right? Everybody qualifies because we're individuals for the most part. You have your small business retirement plans or company-sponsored plans, like your solo 401ks, Roth 401ks, individual. You hear them called different names, but there's multiple plans under that category. And then the third category is what we call tax advantage specialty accounts. So that's your health savings accounts, education savings accounts. You qualify to have accounts in every category. And so one of the ways to really accelerate your wealth building curve is to have those, to have a comprehensive plan, have those accounts dialed in so you know exactly what you qualify for, how they tie to your goal, and how to fund them. And then going one step beyond that, what's the best way to invest the money in those accounts, right, to ultimately achieve the goal. So as an example, why are people real estate investing today? For a lot of people, it's to generate current income, right? That's how we're paying our lifestyle. The reason why you want to incorporate self-directed retirement accounts is because you want to continue that lifestyle in the future without having to work for it. So to your point, Brian, I think you're right. There's a lot of people who they might get some aspect of that. I can just tell you, for most people that I talk to, it's funny. You're right. People will say, I believe in the Roth. I believe in the concept. You don't have to sell me on it. But then the follow-up question is, okay, do you have one and what are you doing with it? Right. You're going to get two completely different answers.
So Edwin, let's talk about that, because I think I want to provide value to our audience. And I think the best way we can do that, and it's going to be nearly impossible. We can't cover everybody's situation. Everything we're talking about today is going to be situational. And what your income level is, what your, all these different things.
Right.
But let's talk about some just basic generic stuff, maybe a framework that we can start to kind of put in place for people who are listening. So let's talk about that person that you just mentioned, Edwin, the person who maybe got started in real estate and they're doing it for today's income today. Where do we start when we start talking about retirement accounts, IRAs, self-directed IRAs, 401ks, health savings accounts? Where do we begin?
Okay, so I'd say there's two places. And so this is based on work that I do with clients, because this is always the question. You need to connect the dots between what you're doing now and what you want to create for your future, right? So how do we connect those two dots? Mm-hmm. I'll give you just two quick approaches to doing that. One approach is to look at the type of investments and where you're holding them. So as an example, a lot of investors are doing quick turn deals, wholesaling, fixing, recapping, right? Those are great strategies that you can use to maximize your current income. When you're looking at replacing that income from your business, a great strategy could be to acquire rental properties or say shares in a property like a multi-unit, which we see a lot of people doing, inside the retirement account, because that generates cash flow, right, for the future. So you've got your cash flow now, and now we've got time to build up that rental portfolio to replace that income at some point in the future. That's one way to approach it. Here's a second method you could use as a real estate investor. I work with a client, and this is kind of what we came up with. He's got his business, and just for the sake of illustration, let's say he's doing 5 transactions a month, okay? And the question is, well, I need to make a certain amount of money to cover all my operating costs, right? My current, right? All these things that we're just talking about. So how do I incorporate the retirement plans into that matrix? Well, one way to do it is, instead of looking at it from an investment aspect or a specific investment strategy aspect, another way to approach it is to say, okay, if I need 5 transactions a month to cover the cost of operations as well as, right, the income that I want to spend and have access to now, then when you come across that 6th transaction or that 7th transaction, those are the ones you do in the retirement account. So if you have access to 7 transactions this month, 5 you do in the business, 7 you do in the retirement account. If next month you only have 5, you do all 5 in the business. But there's a few different ways we can actually connect those dots. The key is that I hear 2 things from people, Brian. One is, it's like, well, I got all the time in the world, I don't need to worry about it right now.
Totally.
Then the other thing I hear is, I waited too long, it's too late. Mm-hmm. I've never heard once, today is the day. I've never heard that in all my years of doing this, okay? And so the reality is, it's never too late, but at the same time, the best time to start is today. So just having a simple methodology like that, look at your business. How many transactions do you need to do? Do an extra one inside the retirement account. And now we're starting to build and grow for the future. You're taking care of both things at the same time, and you're not impacting negatively in any way what you're doing currently.
So that was actually going to be what you just touched on, was going to be one of my questions. So I want to talk about that guy who feels like he has all the time, he or she has all the time in the world. And I'm 25, 30, 35 years old, and I'm doing my wholesale business. I'm making some good money. I'm flipping some houses, making some good money now. I want to start. I want to begin. You've convinced me. I bought a couple of rentals along the way. You've convinced me I need to do something else. Where do I begin? I open up one of these accounts. What type of account should I open up? And then you mentioned doing some deals inside of these accounts. Obviously, that's going to be more like self-directed. Right. How do we get that? Like what's the next step? Bridge that gap for us.
Yeah. So you know what? Here's the other thing too, is that a lot of people think the self-directing is complicated, and it's really not. It's super simple. In fact, it's 3 steps. I call this my triple D process. Okay. The first step, the first D, is to decide. Decide that you want to self-direct. Decide that you want to build wealth for your future, for yourself, for your family's legacy, right? And the moment you decide that, you establish a self-directed account. Now, as a general rule, as you know, we're gonna encourage you and suggest Roth-based accounts. There's different accounts that fall in that category, but just for the sake of discussion, that's the first step. You decide to open an account. That takes all of 10 to 15 minutes, literally, to set up an account. It takes hardly any time at all. The second step is to deposit money into that account. Now, how do you deposit money into a self-directed retirement account? Well, there's a few different ways. One is a contribution. So if you have earned income this year, you can contribute to that account this year. Second way is to transfer. So if you have an IRA or retirement account, someplace else, you can transfer some or all of that money into a self-directed IRA. By the way, that comes over dollar for dollar, no tax, no penalty. When done correctly, that's why I'm going to issue that caveat. If you allow your new IRA administrator custodian to do that for you, it'll be done correctly. You don't have to worry about it. So you've got the account set up, you got money in the account. The third and final D in the process is to direct that money into an investment that you want to make, be it a rental property, be it a contract, be it a share in a syndication. You simply say, this is what I want to do with my money in that account. And literally, it's that simple. It all begins with simply deciding that this is something that you're going to commit to and that you want to do.
So, Edwin, the number one piece of pushback that I get with everything that you described is, I can't touch the money. And since I can't touch the money, I want to go and do it outside of one of these accounts that I can't touch until I'm 59 and a half or whatever the rules are. I can't touch this until then. So I'm going to go do my own thing and I'm going to buy rentals just in an LLC and I want that cash flow today.
Yeah. So I'll address that in three different ways. Or I'll say there's three different options here. There's probably more, but I'll just give you three quick ones. First of all, it's always your money. That's a big misconception that people have. When you put money into an account, it's always your money. You always have access to it, right? And so if you want the money, you can have it. Now, that's not really the question. The question is, what are the tax implications if you were to say, like you mentioned, Brian, take it out before 59 and a half? Well, it depends on the account, but that's another compelling reason and why I'm talking about the Roth, because contributions, since they go in after tax, you're allowed to pull out your contributions tax-free, penalty-free anytime. Okay, so that's one thing that most people are not aware of. So if you put $4,000 in for the next 10 years and you have an account value of $100K, you can say, Edwin, send me a check for $50K. No taxes, no penalties, no nothing.
I didn't know that.
You have access to your money. So that's one thing. A second thing is that there are exceptions to the penalty rules. It's situation dependent, and it depends on the circumstances, but there's ways that we can help you create a strategy where if you want to access the income prior to 59 and a half, not subject to tax or penalty, those are strategies that we've helped clients put in place. Again, I'll be as specific as I can, but this is where like the custom part comes in, because everybody's circumstances are different. So there's not a one size fits all.
Sure.
I can just tell you that it's possible to do that. Okay. And we help clients do that. That's the second. Third thing is, if you have discretionary income today, and to your point, Brian, certainly you can buy real estate outside the retirement account. And actually, I totally recommend that. I'm not saying do everything in the retirement account, but what I am saying is that the retirement account creates an opportunity for you that you don't have otherwise. One opportunity is that the Roth specifically is the only way I know to go from forever taxed to never taxed. It's the only legal way I know to do it. So you can say, yeah, I want the income today, or I want to at least have the idea that I have access to the income today. And you can do that, but what's the price you're paying to the government for that, right? So I would say look at it from that perspective. I'd also say if you have discretionary income, well, then it makes perfect sense to start to shelter it. And usually the people who have discretionary income and are paying taxes, they're the ones who are like, yeah, no, I need to do this, because if you're not spending the money, why the heck are you paying taxes on it? I mean, I don't know about you. I hate paying taxes on money I don't need right now, right? I'm not spending it.
Yeah, for sure. I want to transition, Edwin, now to talk about these specialty accounts that you mentioned, because we haven't talked about this at all. And I actually don't even have any kind of understanding, especially about health savings accounts that I've heard so much about, heard a lot of people talk about. I really want you to kind of dig in to that specifically and talk about what is a health savings account and how can we benefit from that?
Okay, so this is one of my favorite accounts. I use it myself. I've used it for, over a decade, pretty much from the time the government introduced it, which I think was back in 2004 was when the health savings account came online. So the health savings account is the one account where the government married together all the tax benefits of the Roth IRA with the tax benefits of the traditional IRA. So in other words, every dollar we deposit into a health savings account, we get a tax deduction on. We can invest that account, grow it. That money grows tax protected, and every dollar we pull out for qualified medical expenses comes out 100% tax free. Okay, so that's the benefit of the traditional and the Roth all in one place. The health savings account is a critical part of your overall plan, okay, for a couple different reasons. One is that I'll say that, I read various reports on this stuff, Brian. And so one of the reports that I read, actually, the first time I read one of these reports was written by a guy by the name of Ben Bernanke, which people might remember that name, right? Former Fed Reserve Chairman. And Bernanke wrote a report on the healthcare crisis. And the reason why he referred to it as that was he says, healthcare expenses, most people don't add them up during the year, but we pay health insurance, we have co-pays, co-insurance, all these things. He said, it's the single largest expense line item in a household's budget.
Hmm.
I think he was assuming that, or pretending we don't actually pay taxes. So I would probably put it second on the list, taxes being first. So the number one and number two expenditures of any household are basically taxes and healthcare, according to the government, right? The health savings account helps us solve both of those challenges. So what happens is when you deposit money in a health savings account, you can use that money this year. So again, going back to the access part, if you want to use that money this year for current out-of-pocket expenses, even if you didn't invest it, you're using pre-tax dollars to pay for your health care. And when I say health care, not health insurance premiums, I want to be specific, but going to the doctor, those kinds of things. The great thing about it is almost everything is considered a qualified medical expense. Not everything, but almost everything. So you can actually go select the care you want. So like I go to a specialty doctor who doesn't take insurance, right? I can pay for that using pre-tax dollars from my health savings account. Okay, so that's right now this year. The other thing is, Brian, do you have kids?
Yes, sir.
How old are they?
They're 2 and 4.
Oh my gosh. So I've already started dealing with this. You have this to look forward to, right? It's called orthodontics. So I've got 4 kids and every one of them has needed braces. In fact, one of them, the orthodontist told me he's going to need them twice. Like, how do you know that already? You just want to bill me twice, right? Well, orthodontics are not cheap. Well, here's the thing. You can pay for that with pre-tax dollars from your health savings account. Now, here's the other aspect of that. So that's dealing with right now. So you get immediate benefits right now, tax deductions, pre-tax dollars on healthcare expenses, all those kinds of things. But there's something that's bigger out there. And that's this. According to the reports, the average couple in retirement is going to spend 20 to 30 years in retirement. And what the reports estimate is that the average couple is going to need between $240,000 and $280,000 for out-of-pocket medical expenses during retirement, even with Medicare, right? So here's the reality of it. Most people don't even have that for retirement at all, let alone just healthcare, right? This is why we probably all know people who have a hard time buying medications and they're having to pick from month to month what they're getting. So here's a really cool strategy with the health self-directed health savings account. You open up an account, you put some money in it, and you acquire, as an example, one cash flowing asset, call it a rental property. That's effectively all you need to do, because now with that rental property in that account, you can actually fund all your healthcare expenses for the rest of your life, all with pre-tax and no tax dollars. There's another cool thing about the health savings account. There's a couple other cool things about it. One of them is that, and I was having this conversation with a client the other day, long-term care insurance, right? Very important to have, very expensive to have. But one of the things they put in the rules is that you can use pre-tax dollars from your health savings account to make those premium payments. So you can buy long-term care insurance for pennies on the dollar, right, by using tax-free dollars to do that. Another cool thing is that if you're employed or you're getting, say, benefits through your spouse and their employment, one of the other cool things about the rules is that if you or your spouse ever lose their job and you go on COBRA, COBRA is pretty expensive insurance. But the cool thing about it is that you can use, again, pre-tax dollars from your HSA to make those COBRA premiums. So there's a lot of ways that the health savings account helps today as well as the future. I mean, like I said, I've been an advocate of the health savings account for years and years and years. I've been using it myself for years. It's a remarkable thing.
And you just said you can self-direct it too. You can actually buy an asset inside this account, very similar to a Roth self-directed IRA.
You can effectively do all the same things inside a health savings account as you can an IRA account. Yeah.
Yeah. Wow. So Edwin, I kind of asked this question earlier, and I really didn't get. We might have got sidetracked a little bit, and this I know we might have got sidetracked because it's a hard question to answer. But for someone just like me, maybe someone who's in their mid-30s that just doesn't feel like, yeah, I need to have an IRA, I need to have some sort of retirement account. I know I need to do that, but we're clicking along at such a pace with our real estate right now. Like when? The question really becomes when and how. Like, how can I practically, I think you just said, yeah, just do an extra deal a month in here. Well, I need all my deals I'm doing right now. I need them all now. I'm doing all this now. Like the question is when. When do we do this?
Yeah. So I think here's the thing that I'll share with you. It's funny. I was just having this conversation with a client right before I jumped on the line with you. What people will say. So this is the interesting thing. I'm going to break it down into two different things here. I'm going to separate out the issues. So the issue is, do you have a need? What I hear you saying is that, yeah, you have a need, right? You recognize you have a need. Yeah, I want to build a retirement. Yeah, I don't want to pay taxes. Yeah, I got a need for that. But what I also hear you saying, Brian, is, you know what? I don't really want to do it. Not right now anyway, right?
I guess I'm not 100% convinced that I need to be doing this stuff either in addition, probably not aside from, but I don't need to be doing this stuff in addition to what I'm already doing. I feel like I'm already buying rentals that are going to end up being my retirement anyway.
Mm-hmm. All right. So that's a good question. So let's talk about that and drill down on that. You say, so is it that you don't fully, because let's go back. So this is where separating out the issues is really important. So I'm going to take two things you shared with me already. This is a lot of fun for me anyway, because I love doing this. So this is a lot of fun for me. So one of the first things you said to me when we talk about the Roth is, I don't know anyone who says that's a bad idea. We're all doing it. And then you just told me, you know what? I'm not really doing it. Okay, so where's the disconnect? Okay, is it because there's a true disconnect, and here's the thing, and that's okay. The key is, let's flush that out and figure out where that disconnect really lies.
Yeah, so I do have a self-directed Roth IRA that's we rolled over from my wife's previous job, and it's just kind of sitting there. We got a couple of properties in it. I don't feel a need to contribute to that, and I don't feel a need to make that continue to grow just because I am doing all this other stuff on the side.
Okay.
Or that's my primary thing, and I am buying cash flowing assets. What you're saying is it's better to have it over here because it's a Roth and it's tax free.
I'm saying is,
I'm benefiting from the cash flow of these properties today.
Right. And so that's why I'm saying it's not an either or proposition. It's a this and that proposition, right? Because to your point, you're getting the cash flow from some rentals today, and that's wildly advantageous, right? There's no question about it, right? I've got assets that I own because I want the income today. But here's the reality of it, is at some point, right, we're not going to necessarily want to be spending so much time in the business. I don't know about you. I mean, I'll probably always spend some time there, but it's going to be completely on my terms, right? I don't know myself ever. In fact, somebody told me, you're basically retired already because you're never going to do anything different in the future. And I said, oh, yes, I can assure you. I'm going to put in fewer hours at this. I can assure you that. But the point is that we're going to want to make that transition. And so when we start to step out of that business part, right, there's a portion of that income that we lose. Even with the rental portfolio, we're still subjecting ourselves to taxes. The reality is that we can create more wealth by taking the taxes off the table, right, permanently, and building assets and wealth there. Here's another reason. So we've talked about taxes as one reason. And like I said, if we had more time or if we were sitting down together, you know, I could draw out. We could say, okay, doing it outside the account, here's what you end up with. Doing it inside the account, here's what you end up with. Those will be two very different numbers. Now, having said that, that doesn't change the fact that you still want income today, which is why I'm saying we look at create a plan to do both. Here's the reality of it. When I think someone truly understands, when I say understands, like feels it, there's a difference. Like logically, you and I get it, right? We get it logically, but we don't necessarily feel it internally. When we actually can see the difference and feel it internally, it becomes compelling. And that's when people say, I'm going to do this also because I am going to achieve more wealth, larger income, and that's the reason that people are doing it, right? Is for those reasons. There's a second reason I'll just mention to you real fast, which is also a consideration, and that is asset protection.
For sure.
The asset protection features on these accounts is second to none for the most part. And so the nice thing about it is that, and actually I could give you a case study, but I'll just leave it at this for right now, is that if you had a business that went bankrupt, if you personally went bankrupt, courts cannot attach, I'm making a general statement here, but courts cannot attach any kind of judgment to assets held inside your retirement account. So if you own 10 or 15 or 20 properties in your retirement account and that's spinning off cash flow, it doesn't matter what happens outside that retirement account in your business world, your personal world, whatever, that whole thing blows up. You've created an asset base with an income stream that nobody is ever going to take from you, right? That's not only just for you, that goes to your spouse, it goes to kids, right, when they're older. So that's how we talk about legacy, right? And actually creating something that doesn't go away.
For sure. And the answer, it sounds like you're saying is the answer is both. We need to be doing both. I need the cash flow today, but I also see obviously the benefits. I feel it. I feel the benefits of not just the tax benefits, but from the asset protection piece of it as well.
Right. And here's the other thing too, is that, you know, if we're talking about legacy, and now your kids are younger than mine. Okay, so I started having this conversation with some other people that we both know, right? And it's funny because their kids are like my kids' age. And so we were having this conversation. I was having this conversation with a couple of guys, both full-time real estate investors, right? Very successful like you. And they're friends and clients. And we were having this conversation because we said, you know what? Our kids are teenagers now, and we don't want them to be complete idiots in the future, right? And so part of the conversation is, well, how do we get the kids to embrace, because they're growing up differently than we grew up, right? We might have grown up with no money. They're growing up in a totally different world now. So how do we bring them along? How do we get them to understand money and appreciate all these things? And I'm dad, so my kids aren't only going to listen so much to me. And so what we talked about doing is we all have expertise in something different, and getting together with the families, like on a vacation, and bringing them together and talking to them about these things. So they get a perspective from other people other than just, you know, mom and dad. Well, but here's where the retirement account plays into that very, very handily. The nice thing about the retirement account is that in the kid's mind is something for the future. They can't touch it. Right. The other thing is if you've got assets in there, like real estate, and it's spinning off an income, you're effectively achieving the goal that you set out to achieve. In that, you don't want to ruin the kids. You don't want to hand them a pot of cash they don't know how to manage or handle. So by turning over a tax-advantaged income stream that's already fully invested and generating an income, you've basically ensured your legacy over their generation, right? Because the only thing they're going to be able to tap is the income from it. And so retirement accounts, like I said, there's a lot of dots that we can connect. But what I can say is this, and it's not, the reason why I'm in this, and the reason why I'm an advocate of this, by the way, isn't because I own this company. The reason why I own this company is because I am an advocate of this and I see it work firsthand.
I understand.
Those are two not the same things. And so many of life's biggest challenges and problems can be solved by incorporating this as a part of your overall picture.
Got it. It's awesome stuff. Edwin, thank you so much for giving me clarity and hopefully our audience some clarity and some.
I'm going to keep working on you. You're going to start doing more deals in that Roth IRA, my friend.
Yes.
Yeah, I know.
I need to contribute. My thing is I need to contribute. I have 2 houses in it and they're cash flowing. So we bought 2 houses, so it depleted the accounts, and now their accounts are having to build back up with the cash flow, and I need to contribute to it as well.
Yeah.
I agree. Definitely. Health savings accounts too. That's something I don't have, and I definitely need to get going on for sure. Just as a business owner, as someone who, my wife quit her job, so we don't have her insurance anymore. We're paying our own insurance. A lot of times we're out of pocket, a lot of stuff. Just that's something that we haven't done and we need to start tapping into. So great perspective. Hopefully some other people, some of you guys who are listening to this are gaining some perspective as well for your real estate business or any business that you may have. So Edwin, I can't thank you enough. Tell everybody how they can get a hold of you, what services you provide, and stuff like that.
Yeah. So, one of the questions you asked is, what's the best way to get started? So I'll say the best way to get started is for free. So if you go to the website, specializediraservices.com, there's an S on the end, specializediraservices.com. I wrote a new book. We're giving that away for free, along with a consultation. So that first consultation, we usually, depending upon how involved it is, goes anywhere from $97 to $297. But Brian, I appreciate you having me here. So when you go to that website, we're going to give it to you for free, the book, and you can schedule that consultation. And it's in that consultation where, you get to talk about, here's where I'm at, here's where I want to go, here's what the challenges are. And then one of our specialists will help you map out that plan. Yeah. And that's the big missing, and truthfully, that's the missing piece for most people, because if you don't understand how it fits into everything overall, again, you don't feel it, you don't see the value in it. So it's like, well, why kind of do this? It's this side project kind of thing, as opposed to recognizing it for what it is. And that is a way to really help you exponentially, create wealth and achieve those goals faster. So that's the best way to reach us. The 800 number's on the website too. If you don't want to wait and wait for somebody to call you, you can go to the website, call the 800 number, and get it scheduled right away.
Awesome. SpecializedIRAservices.com. We're going to link it up in the show notes. Edwin, thank you so much for your expertise, so much for your perspective. We really do appreciate you.
All right, man. Thank you so much.
Guys, make sure you're hitting that subscribe button right now. Go ahead and do it. Hit subscribe so you get the notifications for our next podcasts that come out. Guys, we have some incredible guests. Edwin was incredible. We got some other incredible guests right around the corner. I'm so excited for you guys for what is on the horizon. Love you so much, and I'll see you next time.